Hey everyone, and welcome back to the channel. If you're worried about your money losing value because of inflation, you're not alone. But what if you could turn this economic headwind into a tailwind for your portfolio? In today's video, we're breaking down the best stocks to buy that actually benefit from high inflation. We're not just listing names, we're diving deep into the specific business models that allow these companies to thrive, from pricing power to tangible assets. Plus, we'll be incorporating the latest ratings and price targets from top Wall Street analysts. Let's find those hidden gems and proven leaders that can help you not just survive, but profit in this environment. Freeport-McMoRan Inc., ticker FCX. Freeport-McMoRan is a leading international mining company headquartered in Phoenix, Arizona, primarily engaged in the exploration and production of mineral resources, with its core business revolving around copper, gold, and molybdenum. The company's principal asset is the vast Grasberg Minerals District in Indonesia, one of the world's largest copper and gold deposits, which serves as the cornerstone of its portfolio. FCX also operates significant mining assets in North America, including large-scale copper mines in Arizona and New Mexico, and has a strategic presence in South America. As one of the world's largest publicly traded copper producers, Freeport-McMoRan plays a critical role in the global supply chain for this essential metal, which is fundamental to industrialization, electrification, and a wide array of technologies, including those powering the renewable energy transition.
First, let's talk about the recent results. Freeport-McMoRan isn't just doing well, it's smashing expectations. In their latest Q3 2025 report, the company posted an EPS of 50 cents, convincingly beating analyst forecasts of 41 cents. On the top line, they hauled in $6.97 billion in revenue, again surpassing the estimated $6.7 billion. This isn't just a flash in the pan. We're looking at a company with a market cap of around $59 billion, TTM revenue of $26 billion, and a solid net income of over $2 billion. They're generating strong cash flow, with a recent quarter showing $2.2 billion in operating cash flow and $3.2 billion in EBITDA. This financial firepower is crucial for what they have planned. So, where is this growth coming from? Freeport is actively fueling its own engine. They're expanding production with major projects like a new smelter in Indonesia and implementing innovative technologies at their flagship Morenci mine. This positions them perfectly to capitalize on the long-term megatrends. Think about it. Electric vehicles use 2 to 4 times more copper than traditional cars. Renewable energy systems like solar and wind are incredibly copper-intensive. And the massive data centers powering the AI boom, they're wired with miles of copper. Global demand is projected to surge by 2030, and Freeport is gearing up to meet it. Beyond organic growth, they have the potential to expand into emerging markets with untapped reserves like Africa and pursue strategic acquisitions. And importantly, they're committed to sustainability, aiming for a 30% reduction in carbon emissions by 2030, which is becoming a key factor for many investors. Now, let's pivot to the challenges. No investment is without risk, and FCX is no exception. The company operates in a capital-intensive industry. Building and maintaining mines requires billions in ongoing investment. They also face geopolitical risks, particularly around their operations in Indonesia, and must navigate a complex web of environmental regulations, especially here in the U.S. Operationally, there have been some hiccups. They've issued a slight downward revision in their 2025 sales guidance for copper and gold, pointing to some mine-specific challenges that could affect near-term output. And finally, as a commodity stock, FCX is inherently volatile. With a beta of 1.58, it's about 50% more volatile than the overall market. When copper prices swing, this stock is likely to feel it more sharply.
So, let's bring it all together. Here's the bottom line on Freeport-McMoRan. Financially strong,
It's beating earnings estimates and generating significant cash flow. Mega trend alignment. It's a direct play on the unstoppable trends of electrification, AI, and decarbonization. Managed risks. While facing operational and geopolitical challenges, these are typical for the sector and the company has a history of navigating them. Let's talk about the consensus. As of late 2025, the message from Wall Street is clear: buy. Out of 24 analysts covering the stock, 15 are giving it a straight-up buy. 4 are even more bullish with a strong buy, and the remaining 5 recommend hold. But here's the most telling part. Not a single analyst is saying sell. 0. That's a powerful vote of confidence in itself. This bullish sentiment isn't static, it's been growing. In just the last 90 days, we've seen several analyst upgrades and very few, if any, downgrades. Major firms like Scotiabank, Bank of America, and Morgan Stanley are all maintaining positive outlooks, so the trend is firmly pointing up. Okay, so they like it, but how much upside are we talking about? The stock is currently trading around $41.70. The average 12-month price target from analysts sits between $47 and $48. That implies a very solid 14 to 16% upside from today's levels. But some firms are even more optimistic. We're seeing price targets as high as $55 to $56. If the stock hits that, we're looking at a potential gain of over 30%. That's the kind of return that gets investors really excited.
Archer Daniels Midland Company, ticker ADM. Archer Daniels Midland Company is a global leader in agricultural origination and processing, connecting the harvest to the home by transforming crops and resources into a vast portfolio of food, beverage, nutritive, and industrial products and ingredients. Its core business revolves around sourcing, storing, transporting, and processing oilseeds, corn, wheat, and other agricultural commodities into products such as vegetable oils and protein meals for animal feed, as well as sweeteners, starches, and flavor systems for the food and beverage industry. Furthermore, ADM is a major producer of biofuels, including ethanol and biodiesel, and is increasingly focused on innovative solutions for sustainable food and energy, leveraging its extensive global supply chain network that spans from farms to end consumer markets. First, let's look at the reasons for optimism. ADM isn't just sitting still. They've launched a major strategic plan to navigate the current environment. Massive cost savings. They're targeting a huge $500 million to $750 million in cost efficiencies over the next 3 to 5 years. That's a direct boost to the bottom line. High-growth nutrition segment. While their core business is under pressure, their nutrition unit, especially flavors and food ingredients, is a bright spot. This is a higher-margin business that diversifies their revenue. Financial flexibility. They plan to monetize around $2 billion in assets. This isn't just about raising cash, it's about simplifying their portfolio and strengthening the balance sheet, which should please investors. Long-term demand. The world will always need food, feed, and increasingly biofuels. ADM's massive scale and central role in the agricultural supply chain provide a solid long-term foundation. So the company has clear levers to pull, but, and it's a big but, they're facing some serious headwinds right now.
2025 is shaping up to be a transition year, and it might be a bumpy one. Earnings decline. The most glaring issue is expected earnings softness. Analysts project a potential 19% decline in Q3 2025 EPS. The core ag services and oilseed segment is feeling the pinch from lower commodity prices and compressed margins. Profitability squeeze. Operating margins have taken a significant hit. This isn't just a revenue problem, it's a profitability challenge across key parts of their business. Regulatory risks. Policies around biofuels are always a variable. Any shifts in government mandates can create uncertainty for a key part of ADM's business. Dividend growth limit. Now, for the income investors, that attractive 3.3% dividend yield comes with a caveat. The payout ratio is sky high, around 90%. This means almost all of their earnings are going to the dividend, leaving very little room for growth and making it more vulnerable if earnings fall further. So, where does all this leave us with the numbers? With a market cap of $29 billion and revenue over $82 billion, ADM is a behemoth. However, its trailing PE ratio is around 27, which looks expensive for a company facing earnings declines. The more telling metric is the forward PE of 13.9, which prices in some of this expected softness. One thing income investors will love is the beta of 0.68. This means ADM is significantly less volatile than the overall market. It's a stable, defensive holding. But again, that high payout ratio is a red flag you can't ignore. ADM is a long-term play, not a 2025 home run. If you're a conservative, income-focused investor, the steady dividend and low volatility are very appealing. The company's cost-saving plans and portfolio simplification are the right moves for a rebound, likely by 2026. The consensus from the pros is crystal clear, but not exactly exciting. Out of 9 Wall Street firms covering ADM, an overwhelming majority are telling clients to hold. The breakdown is 7 holds, just 1 buy, and a single sell recommendation. The average 12-month price target for ADM sits around $55.50, with the stock currently trading near $60.50. Analysts collectively see a potential downside of about 12%. That's not a great starting point if you're looking for a stock to buy today. Major firms like UBS, JP Morgan Chase, and Morgan Stanley are all in the hold or neutral camp. So what's the other side of the story? Why isn't everyone just selling? The analysts do acknowledge ADM's strengths. They highlight the company's steady dividend yield, which provides some income while you wait. They also point to strategic cost-cutting and improvements that ADM is implementing to navigate this tough period. The company also has a solid history of meeting or beating earnings estimates, which shows operational discipline.
Halliburton Company, ticker HAL. Halliburton Company is a leading American multinational corporation and one of the world's largest providers of products and services to the energy industry, with a rich history dating back to its founding in 1919. Operating in over 70 countries, its business is primarily organized into 2 main segments: completion and production, which offers tools and services for constructing, completing, and optimizing wells, and drilling and evaluation, which provides services for field and reservoir modeling, drilling, and precise formation evaluation. The company plays a pivotal role in the oil and gas sector by delivering cutting-edge technology, expertise, and integrated solutions for hydrocarbon exploration, development, and production, helping its clients maximize recovery and operational efficiency throughout the entire life cycle of an asset. Let's look at the numbers. Halliburton is a behemoth with a market cap of around $23 billion. Their revenue over the last 12 months is a hefty $22.1 billion, but net income sits at a much smaller $1.31 billion. This tells us it's a volume business with tight margins. The TTM EPS is $1.52, giving it a PE ratio of 17.7. However, the forward PE ratio is lower, around 12.8, suggesting the market expects earnings to grow. For income investors, there's a decent dividend yield of 2.53%. Now, the most recent data point is crucial. In Q3 2025, Halliburton beat earnings expectations. They reported revenue of $5.6 billion, slightly above forecast. More importantly, while their GAAP earnings were low, the adjusted net income came in at a strong $596 million, or 58 cents per share. This shows underlying operational strength even when the headline numbers look soft.
So, why are analysts optimistic? It boils down to 3 key areas. Technology leadership. Halliburton isn't just about drilling holes. They're pouring money into electric fracking fleets and digital oil field solutions. This makes them more efficient and a partner of choice in a greener, conscious world. Aggressive cost cutting. They're on track to save about $100 million per quarter. In a tough market, that kind of discipline directly protects the bottom line. And international strength. While North America is soft, their business in the Middle East, Africa, and Latin America is booming. This geographic diversification is a major buffer. Plus, they're positioning themselves for the future with ventures into carbon capture and clean energy tech. Now, we have to talk about the risks, and they are significant. The company itself has warned that full-year 2025 revenue is expected to decline. Drilling activity is softening, especially in their key North American market. This is squeezing their profits. Their operating margin has compressed from 11.6% down to 8.4% year-on-year. That's a big move. They also face geopolitical risks, potential tariffs, and fierce competition. The outlook for the North American market in 2026 is still cloudy, creating uncertainty. So, with this mixed picture, what's the verdict from the pros? The consensus rating is a moderate buy. Out of 24 analysts covering the stock, 16 have a buy rating, and 1 has a strong buy. The remaining 7 recommend hold. The average price target is around $31.13, which implies a potential 16% upside from the current price near $26.80. And there are notable bulls out there. Rothschild Redburn recently initiated coverage with a buy rating and the $35 price target. That's over 30% upside. The analyst community seems to be betting on Halliburton's management to execute their strategy, control costs, leverage their international and tech strengths, and wait for the cycle to turn. This isn't a simple high-growth tech story. HAL is a cyclical stock showing resilience. It's a play on disciplined management, global energy demand, and a belief that their technology investments will pay off in the long run. What do you think? Is Halliburton a buy, hold, or sell for you? Let me know in the comments below, and don't forget to like and subscribe for more deep dive stock analysis. Thanks for watching.